YouTubers, Mike Martin's here, Mike Martin's channel, Australian economy. Viva Australia, news.com, Australia. Yes, Viva Australia. What's going on. Housing prices to fall by 7 points. 7%. This is from Down Under for May 4, 2017, 5:21 p.m. Oh, yes, I did watch the video. It was very, very entertaining. I'll leave a link below if you want to watch it. House prices could fall by as much as 7% over the next 2 years. That's a long time. In partial correction, as supply catches up to demand and regulators stem the flow of household debt, Citi has warned. But you know what? That 7% is enough to trickle people turning in their keys. If someone just bought at the top, no one will pay for a house that's worth less than what they bought it for. So if you bought a house for $1 million, it goes down 7 points. Your house is worth $960, and you can get, I'll give this is an example, right? And you can get equity out of it, and you're basically paying for something worth less than what you bought it for. This might trickle down into a bigger problem. So, fingers crossed, people. In a note this week, the investment bank warned that a correction was likely, with the risk related to unwinding housing boom potential more challenging to manage than the end of the mining boom. That was West Australia, if you guys remember the article I read, how homes are underwater there. Well, not physically, but financially. Given the stretch house price valuations in Sydney, Melbourne, some corrections would seem likely to supply continues to catch up demand, Citi Analysis wrote. They argue that the recent moves by regulators limit growth in interest-only mortgages. That's horrible. Would have much more meaningful impact than the earlier 10% cap on investors' lending. This is such a bad house of cards. Our model suggests that the run-up of house prices was facilitated by rising household debt, they wrote. Go figure. If APRA succeeds in limiting further rises in household debt and unlimitedly, we see the mild diverging. I don't know. It's probably Australian language. There could be a partial correction in house prices during the course of the next 2 years. Oh, so what they're going to do is they want to put a little icing on this article to make it show it's going to go down, people. But don't worry, it's normal. Hold on. No way. This could be the case even if population growth remains strong. What population growth? People can't afford to have kids. In our view, the largest price falls would be higher rise or high rise? Inner city apartments, higher rise? It's high rise. I don't know. Too much sun today. Inner city apartments in Brisbane and Melbourne, given their greater potential for oversupply. They're not mentioning the 100,000 empty condos they have in Australia from investors. Oversupply my buttocks. Either way, we aren't accepting large enough price falls to trigger a downturn in economy, but the downside risk has risen as house prices and household debt have continued to increase briskly, slowing Chinese investments in the market with lower level of foreign investment applications at FIRB and possibly lower immigration add to these risks, as would further out-cycle lending rates rises. Once again, I think this is an icing on the cake that's just to calm investors. It's 7%. It's going to go back up. It's going to find a correction. I'm predicting 30-40%. It comes after UBS last week also called up the top current housing cycle, but stopped short of predicting price falls, while the historical trigger for a housing downturn of RBA hikes is missing. Mortgage rates are rising. Uh-oh, red flag right here. And a sentiment of home buying collapsed to a near record low, UBS Analysis wrote. A survey of 34 economists and experts by comparison website finder.com.au earlier this week found more than half agreed that the housing market had peaked. It had peaked. Data from research of CoreLogic, showed the Sydney price growth was flat in April and rose only slightly in Melbourne. The soft result came after the dramatic capital gains in the second half of 2016 and the first 3 months of 2017, which saw Sydney dwelling values surge 11.3% and Melbourne 12.6%. APRA's tightening measures probably contributed to April's prices result by Easter and school holidays. Oh yeah, may have contributed to the slowdown. I love this icing. What kind of ingredients are in this friggin' icing? Because they're just trying to pull everything out. City Analysis wrote, "Time will tell. We doubt the RBA and APRA will rush to judgment." Oh, let's read the rest of it. Harvey Norman financing housing hit. In the event of a housing slowdown, retailers would feel burnt of the impact as housing turnover is a large driver of consumer spending, DIY home renovations, new appliances, AV equipment, and furniture. Remember that when people were taking second and third mortgages and liens on their house to buy cars and RVs and crap like that, and they weren't saving it for their kids? I mean, or their retirement? What a bunch of losers. City points to the last house price slowdown. One fell nationally by 5%, 18 months between June 2010 and December 2011, in which both Harvey and Norman JB Hi-Fi took major sales hits. But you know what? 2010, 2011, the average house was $430. Not $2.4 million. Harvey Norman was, $2.4 million, a 7% hit is huge. So Harvey Norman was the latest share price downside on the housing correction. City Analysis wrote, "We assume Australian franchise sales declined by 5% and earnings declined by 28% in the housing downturn scenario. They're raising interest rates, people! People are not getting paid enough." While JB and Hi-Fi's legacy business has limited housing exposure, with the predicted sales decline of 1% in the housing slowdown, retailers' acquisition of the good guys has increased its exposure in housing materially. Sorry, guys. Matterly. Sorry, I'm just out of it today like you wouldn't believe. Too much sun today. Appliances now count for 26% of the group sales and from 4% of prior to acquisition. Similarly to Harvey Norm, we expect the good guy sales to decline by 5% under this scenario. So they're trying to ice it up here, get it all like letting, hey, it's going to go 7%. Don't panic, Cardanic. It's all good. When it goes down 7%, it's going to streamline and maybe go back up. You know what, guys? I see a lot of people try and turn their keys back into the bank. 7% off $1 million is huge. You don't want to pay for a house that's worth less than what you bought it for, and then holding on to it, hoping that it goes up. It's like buying a failed stock on the New York Stock Exchange that you bought in at the wrong time, and you're hoping that it goes back up. I want to know what you guys say. Think about this. I'm reading some of these words here. Some of these words I just don't read too often. And housing materially, like some words in here, I just don't know what they mean, right? And I guess I need to expand my English vocabulary, you know what I'm saying? Anyways, let me know what you guys think. Is this just icing on the cake to how do you say, comfort investors that bought at the top? Let me know, comment below.